What's up, YouTube family? I hope everyone is doing well. I wanted to provide you with another update on the markets today, June 1st. This is the first day of the month, the first day of the last month of this quarter. And we saw a lot of positive momentum in the market continuing to rise higher. And this is in the face of so much going on in our country, from social unrest to the coronavirus still out there with no vaccine to it, high unemployment, and so many things that are going on. I'm going to talk about all of that coming up next. Hello everyone, my name is Paul Zachary Shelton Jr. and I'm the Chief Investment Officer of Warwick Advisors. We are a wealth and investment management firm located in Orlando, Florida, with clients all across the United States. If this is your first time coming to my channel, I ask that you please hit the subscribe button, please like and share this video to help me increase the financial literacy of our globe. Additionally, I want to offer you a free financial planning cheat sheet. This cheat sheet will give you a snapshot of your current financial health, and it'll also provide you with an asset allocation that you can use to invest in today's current market landscape. So let's go ahead and jump into the performance and what took place today on Wall Street. There is so much going on. A lot of things that are going on outside of Wall Street are very, very negative, but for some reason the market continues to grind higher against all the negativity. And I'm not just talking about negativity from the riots and the social unrest and the social injustice that has taken place in our country, but I'm talking about is continuing to rise against all economic sense, all economic data. Right now we have a stock traders market. It's trading on free money, on stimulus money. We're not seeing trading on economic news that is current to today. So let's dive into it and look at what happened today. The equity markets continue to rally today, with the Dow rising and the S&P both rising about 30 basis points higher today. The S&P 500 is really now only 5% away from reaching the flat line for the year. It appears that the market is pricing in a V-shaped recovery. There's many believers out there that think that this won't be a V-shaped recovery, but as of right now, it was a V that went straight down from March to April, and then it looks like it is slowly climbing out of that trough that it was in. But the horrible thing, or the thing that's kind of frustrating, is that this is really in the face of several economic data points that are not agreeing with the market rally right now. I mean, the hopes of the U.S. economy reopening fully and everyone getting back to work to generate the level of economic activity that we saw at the end of 2019 continues to drive the economy. This is despite everything that I mentioned before, all the social unrest that we have seen in the wake of the murder of George Floyd, and additionally, all the rioting that's been taking place in this country. This is really painting an economic picture that is just not as rosy. And on top of that, we still have some tension between the United States and China that has not been solved. There is a trade agreement in place right now, but tension is still there and it is rising. And it is yet to be seen if any side, whether it's the US or China, will break that trade agreement that's currently in place. And not to forget about everything that started this whole economic storm that we've seen over the first half of this year, really over the last 3 to 4 months, the coronavirus. There is still no vaccine for the coronavirus. And in many spots around the country, as the country is reopening, we have started to see a rise in new cases of the virus. So there's so much that is going on right now. And I didn't even mention one of the most important data points, and that is the unemployment rate. We have over 40 million people in this country that are unemployed. That is significant for a country with 300 to 350 million people. 40 million people that are unemployed, and approximately 1/5 of that 40 million will be permanently unemployed. So even if we are in the best case scenario where everyone gets called back to work tomorrow morning, except for that 1/5, that 20% or so that are not going to get called back and they're going to be permanently unemployed, we would still be in a situation, in a economic unemployment situation that is twice as worse as the Great Recession that we saw in the 2000s, just based on no other data points but just the unemployment rate itself. The S&P 500 is currently above its 200-day moving average, which is a technical level that typically gives investors insight on the potential direction of the market. This is based on a technical analysis and not fundamental analysis. Again, we're trading right now on this stock market free money. We're not trading on anything fundamental in our economy. We're trading on the hopes of the economy reopening soon and opening to full capacity. We're trading on the hopes that everyone's going to get back to work. We're trading on the hope that everyone is going to start spending money again. We're trading on the hopes that everyone has been home and locked up in their houses for so long that they will have no choice but to go out and spend money. That doesn't factor in the fact that people are unemployed and people are going to save money. I mentioned in a video last week that the savings rate in this country hit an all-time high of 33%. This country is smarter than it was. The citizens do remember what took place between 2008 2009. A lot of people are saving money, preparing for the worst. They're not out spending willy-nilly, especially without the surety and the certainty of any economic stimulus coming or another round of stimulus payments being sent out to individuals. This chart shows here the S&P 500 over the last year. And from a technical standpoint, the market is getting a little overbought as the RSI, the Relative Strength Index, is approaching 80. As of the close of today, it is currently at 64, which isn't technically overbought, but it is warming up to that notion. The 50-day moving average is trending upwards towards the 200-day moving average. A cross of the 50-day over the 200-day from the bottom typically signals support for the current trend of the economy. However, there is a large gap between the 50-day and the 200-day moving average as of right now, so it's still a lot to be seen as to the direction the economy will take. This chart shows Zoom, which is another stock that has done tremendously well during this coronavirus pandemic. As one of the many stay-at-home stocks that has shined recently by providing a platform for many people to stay connected during social distancing, this stock has been trending above its 200-day moving average since February, and the Relative Strength Index has moderately risen during this time. So even with the significant outperformance that we've seen in this stock, it is not showing that it is overbought. At least it hasn't jumped. The Relative Strength Index, which measures how hot the stock is, has not jumped in tandem with the value of the stock price and the movement of the stock price. So as I mentioned in a video last week, I'm curious to see what's going to happen as the country continues to reopen. It seems like most of the stay-at-home stocks have a little steam in them, but they're starting to lose their luster. Please leave a comment below if you have any questions about anything that I mentioned in this video. Also, if you're interested in the free financial planning cheat sheet, please leave your information below. I will send that over to you. It's completely free of charge. And lastly, before you leave my channel, I ask that you please hit the subscribe button. Please like and share this video to help me increase the financial literacy of our globe. Thank you so much and have a great day.